All right, welcome to the deep dive. We've got this really interesting stack of sources you've brought over, all focusing on PSU banks, specifically these PSU bank ETFs.
That's right. Yeah, the material you shared, it really zeroes in on this topic. We're looking at, well, two things really. The public sector banks themselves, their health, and this specific way to invest the ETF.
Exactly. So our mission today is kind of unpacking what these sources are saying. What is a PSU bank ETF? What's actually in it?
Uh-huh.
Why are the sources talking about this sector right now? What potential do they see? And, well, why the ETF approach specifically?
It's a great set of materials because they tackle it from both sides, don't they? You've got the fundamentals, what's actually happening with the banks.
The core business.
Yeah, and then the investment structure, the ETF wrapper around it, all based on the analysis presented in these sources, of course.
Okay, let's jump right in. First things first. What is an ETF? How do the sources explain it?
Well, the material puts it pretty simply. An ETF, that's an exchange-traded fund. It's structured a lot like a mutual fund, holds a basket of things.
Like stocks or bonds?
Exactly. But the key difference they highlight is how it trades. It's listed on the stock exchanges, NSE, BSE.
Oh, okay.
And you can buy or sell it throughout the day, just like you would, say, shares in a single company, at whatever the market price is at that moment.
Got it. So fund structure, stock trading flexibility. Makes sense. Now let's look inside these specific PSU bank ETFs. The sources mention the nifty PSU Bank Index. What's in there? They seem quite detailed.
Oh, they are. Very specific. The sources show the biggest slice, by far, is State Bank of India, SBI. It's weighted at around 30%.
30%? Wow, okay. That's substantial. Who's next? Bank of Baroda, I think?
Correct. Bank of Baroda is listed next, and it's got about 20% weight.
Okay, so hold on. Just those two. SBI and Bank of Baroda. That's like 50% of the index right there.
Pretty much. Half the value, yeah, in just the top two.
That's quite concentrated. What about the next few banks?
Well, according to the sources, if you add in Punjab National Bank, PNB, and Canara Bank, those four together make up about 75%.
75% in just 4 banks.
Okay.
And the sources also mentioned adding a few more gets you almost the whole picture.
That's right. Throw in Union Bank, Indian Bank, and Bank of India. And across those 7 banks, you're looking at roughly 90% of the index weight.
So the rest, the final 10%, is just scattered among the other PSU banks.
Exactly. And the key takeaway for you, listening, is that buying the ETF means you're buying the specific mix. You get all these banks weighted exactly like the index in one go.
Right. You buy the basket. Okay, that composition's clear. Now the big question, why PSU banks now? What's the fundamental story the sources are telling? What's driving this interest?
The material really paints a picture of significant improvement. The main things highlighted are, well, record profits and really low non-performing assets, NPAs.
NPAs being the bad loans, essentially.
Exactly. Loans that aren't getting paid back, that's always been a big concern for banks, and the sources say these levels are way down.
And they have actual numbers for the big banks too, don't they?
Oh, yeah, very specific. The analysis points to SBI's recent net profit being around 57,000 crore, and its earnings per share, EPS, around 62, both highest ever, according to the source.
Highest ever profit and EPS for SBI. Wow. And Bank of Baroda.
Similar story presented. Their latest net profit is cited at about 15,000 crore, again, highest ever for them, along with their highest ever EPS.
And the sources actually use phrases like lowest ever MPA and highest level profitability, right? That combination sounds pretty powerful.
It does. And what makes it even more interesting based on the source material is the valuation side of things. Despite these record profits and clean books.
They're cheap.
Well, the sources point to many trading at very low price-to-earnings ratios. PE ratios. They give examples like Union Bank around 6, Canara Bank maybe 5.
Those are low PE ratios, especially for record profits. And didn't the sources also mention some trading below book value?
Yes, that's another key point they make. Book value being like the net worth per share on paper. They cite Union Bank having a book value of 100 but trading around 71.
Significantly below.
Yeah, and they mention Canara Bank and PNB are also trading below their book values according to the analysis.
So the sources are basically saying record profits, cleanest loan books ever, yet the market is valuing them very low, sometimes even less than their assets minus liabilities.
That's precisely the core argument presented in the sources. This apparent disconnect between the improving fundamentals and the current market valuation is highlighted as the potential opportunity.
Okay, that's a compelling fundamental picture laid out in the sources. But they don't stop there. They bring in technical analysis, looking at the price charts. What do they see there?
They take a long-term view, looking at the nifty PSU Bank Index chart going back to 2010, over a decade.
And what's the pattern?
What they highlight is this recurring theme. The index hitting a certain price level, a ceiling almost, multiple times over those years and struggling to break through.
Like a resistance level.
Yeah, exactly. But now, the sources suggest something might be different. They identify what technicians call a potential cup and handle pattern forming.
Which is usually seen as bullish, right? Suggesting a potential breakout.
Correct. It often precedes a move higher, and crucially, the sources emphasize this isn't just a chart pattern in isolation. They state it's backed up by those strong fundamentals we just talked about.
The profits, the low NPAs.
Right. And also by high trading volumes recently, which can suggest strong buying interest as it approaches that old resistance level.
Now, this is where the sources get really specific, laying out potential targets based on this technical view. What numbers do they mention?
They give quite clear targets. For the nifty PSU Bank Index itself, the technical target cited is around 7,600.
7,600. And where is it now, roughly?
Around 4,084, according to the source material. So yeah, that target implies a potential gain of something like 86%.
86% potential upside on the index. That's huge. And what about for one of the ETFs that track it?
Well, they mention a specific one, Nippon Bank Bees, as being quite liquid. For that ETF, the technical target mentioned is around 90.
And its current price?
The source notes it was trading around 45.40, so you're looking at potentially almost 100% gain there, doubling your money based on their technical analysis.
Wow, nearly doubling.
Right.
That's obviously very attractive. Do the sources give any sense of how long this might take? An 86% or 100% gain doesn't usually happen overnight.
No, and they absolutely acknowledge that. The sources are quite explicit that the main uncertainty, the primary risk they flag here, is the timing.
Okay.
Reaching those targets isn't guaranteed to be quick. It could take, maybe 1 year, maybe 2 years, possibly even 3 years. That duration is the unknown.
Right, so the potential is there according to the analysis, but patience might be needed. Still, even if it took, say, 2 years to get that 86% index gain.
Well, yeah, even over 2 years, that averages out to about 36% per year, which is still a very significant return. And the sources try to fundamentally justify why the market might support such a price rise eventually. They suggest that the underlying net profits of these banks could potentially double in a couple of years, too.
Ah, so the earnings could grow to catch up and support the higher valuation, even if the price doubles. Makes sense.
That seems to be the rationale presented.
Okay, so we've got fundamentals, we've got technicals. Now, why the focus on the ETF in these sources? Why not just tell people to buy SBI or Bank of Baroda directly? What's the advantage of the ETF structure they highlight?
They point out a few key practical benefits. First, simplicity. The ETF gives you instant exposure to that whole basket of banks, those main 7 to 10 players we talked about.
Without having to buy each one individually.
Exactly. It saves you the hassle of picking stocks, deciding how much of each to buy, and managing all those separate positions.
And it avoids the risk of picking the wrong horse, maybe, like choosing one bank that underperforms the others.
That's another point mentioned in the sources, yes. It reduces that individual stock risk. You get the sector's performance automatically diversified according to the index weights.
And there was a cost angle too, right? Lower fees.
Definitely highlighted. The expense ratio of these PSU Bank ETFs is mentioned as being quite low, around 0.49% in the example given.
And how does that compare?
Well, the sources contrast that with typical actively managed mutual funds, which might charge, 1% or even 1.5% per year. So the ETF is presented as a significantly cheaper way to get that broad PSU bank exposure.
Cost efficiency is always good. Did they mention any specific ETFs apart from the Nippon one?
They primarily focus on the Nippon Asset Management PSU Bank ETF, Bank Bs, calling it the oldest and most liquid. But they do also note that ICICI Prudential has a similar offering.
Okay. So wrapping up the analysis from the sources, we have strong fundamentals, bullish technicals with big targets, and the ETF structure offering easy, diversified, low-cost access. What about the downsides? What are the main risks the sources flag?
Really, the only significant risk that's explicitly discussed within the context of this potential opportunity presented in the sources is that uncertainty around the timeline.
How long it might take to reach those targets?
Precisely. The underlying conditions are presented as very positive. The technical pattern looks promising according to the analysis, but when or even if those price targets are ultimately reached, whether it's 1 year, 2 years, 3 years, or longer, that's the key variable and risk highlighted in the material.
That makes sense. The destination painted by the sources looks attractive, but the travel time is uncertain.
You've got it.
Well, this has been quite a deep dive. Thanks for walking us through the sources you provided. We've covered the ETF basics, seen what's inside the nifty PSU Bank Index according to the material,
Uh-huh. The key banks and weights.
unpacked that fundamental story of record profits, low NPAs, and low valuations presented in the sources, explored the technical cup and handle and those significant potential targets they identify,
Nearly 100% in some cases.
and understood why the sources highlighted the ETF for its diversification and cost benefits. A really comprehensive picture drawn from the material.
And just to reiterate, everything we've discussed, the numbers, the analysis, the potential upside, the timing risk, it all comes directly from that source material you shared. We're reflecting what's in there.
Absolutely. So, thinking about everything we've pulled from these sources, what's maybe one final thought for you, the listener, to chew on?
I think the most interesting thing emerging from these sources is that unique combination they describe. You've got what looks like real structural improvements in these banks, the NPA cleanup, the profit surge happening at the same time as valuations seem, according to the analysis, quite low, and there's a technical pattern suggesting a major move.
Right, several things aligning at once.
Exactly. So the thought to maybe ponder is, how do you weigh that potential reward, that substantial gain the sources talk about, against the acknowledged uncertainty of when it might materialize? Considering that trade-off between the potential scale of the return and the patience required as presented in these sources seems like a really core element to reflect on after this deep dive.